What's up everyone, Taiki here, and I wanted to continue my book summary series, this time with The Most Important Thing by Howard Marks. And from this book, I'll take some excerpts, give away some of my personal commentary, and how I think it applies to the crypto markets, because that's the market I specialize in. So if you like the content, please like and subscribe, and let's get right into it. And when I read these books, right, I'm not claiming that I'm like a smart person, right? I'm just trying to learn from these investing, wizards, and try to apply it to the crypto markets, and hopefully you get something out of it as well. And make sure to check out part 1 and 2 in the playlist from my YouTube channel. So Howard Marks, I'm sure you've heard of him. He's an older guy, right? And I'm sure that he knows nothing about crypto, but I'm sure he knows a lot about, managing money and not blowing up. So Oak Tree Capital Management, as of, a couple years ago, they managed over $164 billion for their clients. So, I would think that he knows a thing or two about, investing and trading. Of course, he comes from a non-crypto background, aka boomer, but I think it is useful to take his lessons over the last couple of decades and think about how it applies to our magic internet beans, aka crypto. So in the first couple pages of this book, he mentions that experience is what you get when you didn't get what you wanted. Good times teach only bad lessons, that investing is easy, that you know its secrets, and that you don't need to worry about risk. The most valuable lessons are learned in tough times. And I think we can all relate with this. We enter crypto in a bull market because numbers are going up. You put a bunch of money because numbers going up, and then it keeps going up, and you feel like you're a genius. And then good times don't last forever. And when bad times hit, our coins go down a lot more than we expect. And through the bear market, we reflect back on our mistakes, and then we strive to do better. Okay, like you can't just assume that in a bull market you're a genius, right? In a bull market everyone is a genius. It is only those that survive bear markets and reinvest those profits in a bear when prices are much lower that really benefit in the upcoming cycle. Kind of reminds me of this meme, right? Hard times create strong men create good times create weak men, and weak men create bad times. Yeah, it's just a virtual cycle, and it doesn't matter if it's a stock market or crypto. It's just how investor and trader psychology works. And in the book, he shares 20 of the most important things in investing. He talks about 20 different things. I'll just cover the things that I think is most relevant. So I'm probably going to cover like 12 to 15 of the most important things, because I think that resonated with me, and some things are just not as relevant. So the first most important thing is second level thinking. And, the way I think about it is you can't just read something on the internet and just expect, hey, that's alpha, right? First level thinkers think the same way other first level thinkers do about the same things, and they generally reach the same conclusions. By definition, this can't be the route to superior returns. All investors can't beat the market, since collectively they are the market. It's similar to how 90% of traders lose money, right, trying to trade the markets. But if you think like those 90% of people, then by definition, you are a loser. So in order to succeed, you can't think like the 90%, you have to think like the 10%. And it's easy to be in the markets and think that, I'm so smart, I'm not part of the 90%, but statistically, you are probably likely the 90%. So it's really, really important to think outside the box. And the way to do so is by second level thinking, right? You can't just read something and just reach particular conclusions. Anyone can do that. You have to read something and then be like, well, if this is the case, then what is the market not considering? And if that's not being considered by the market, how can I profit off of their ignorance, right? Their ignorance is my alpha. That's kind of how I think about it. And this is like a pretty common crypto meme, right? Where it's kind of like this pyramid where the VCs or the influencers, they get some private allocations, they shill it to their friends, but their friends shill it to more people, and then those people shill it to their audience. And then, the further you get down in, the pyramid of, insider tokens, the more likely it is that you're going to get wrecked. And I've definitely started down here, and I'm trying to, climb up the ranks, hopefully. Not in the sense that, I'm going to do private investments and dump on followers. I don't do private investments, I don't do paid shills, but more in the sense of, you can't just go on Twitter, log in, read some bullish post on something and just buy, right? That's not really how the markets work. You have to really think critically about, okay, can I actually extract value? How can I actually profit? And where I think the space is going forward. When it comes to investing, I'm more of like an investor, not like a short-term trader. I think more about, okay, well, this is where the markets are now, but where do I think the markets will go in 6 to 12 months, right? The markets are forward-looking. You can't just invest on what the state of the market is now. You kind of have to, think critically about where the market is going and predict, where attention is going to flow. A lot of ways, some mainstream social media is first level thinking, right? People just want to be told what to think. People want to be told what to buy. But by definition, these people are statistically likely to just get wrecked. Second level thinkers reach their own conclusions, and that's how you derive alpha, I suppose. The second most important thing is understanding market efficiency and its limitations. And yeah, there's a little segment here, or an excerpt here. Second level thinkers, so this is kind of tying into like the first point, they know that to achieve superior results, they have to have some edge, right? If you don't know where your edge is, then you don't have an edge. It's kind of similar to if you walk into a poker table, you sit down and you can't identify the bad players, then you are the bad player. Similarly, you kind of have to have a process when it comes to trading, investing, farming, yield farming, airdrop farming, whatever it is, you have to have some type of an edge. And like everyone's edge is different, right? Like my edge is different from your edge, and your edge is probably different from some like random influencer's edge. But if you can't define your edge, then you shouldn't be risking that much capital in the markets. So the edge has to be in either information or analysis or both. They're always on alert for instances of misperception. My son, Andrew, so Howard Marks' son, Andrew, is a budding investor, and he comes up with lots of appealing investment ideas based on today's facts and the outlook for tomorrow. But he's well trained. His first test is always the same. And who doesn't know that, right? You can't just look at a particular coin that's being shilled, right? And like the metrics look amazing, but then you should ask yourself, well, like if that guy's shilling it and that guy's shilling it, then everyone knows that, right? So you should expect that information to be already priced into whatever markets that you're looking into. Of course, it depends, right? It's not always priced in. The meme is of like, it's priced in, and the markets are not efficient, especially in crypto. But you always have to think about, okay, like, but who doesn't know that, right? Because like if it's being posted every single day, then chances are everyone knows that, and everyone that wanted to buy probably has already bought. And if that's the case, then who's left to buy after you? Probably not that many people, and that creates tops. Investing is a popularity contest, right? People want to be part of the crowd, right? People don't want to buy stuff that everyone is not talking about. People want to buy stuff that other people are talking about because it gives them confirmation bias. Like if you're looking at a coin and it's going down, and then someone tells you that it's going to go up, then it's like, yes, like, I agree with that guy, right? I know that it's going to go up. But if something's going down and no one is telling you that it's going to like go back up again, it's like, oh, like, it's probably over, right? It's very psychological, especially in crypto, when there's not that many cash flows backing these assets. It's more around attention, sentiment. Investing in crypto is really a popularity contest. And the most dangerous thing to do is to buy something at the peak of their popularity, because at that point, there are no more incremental buyers. Who doesn't know that, right? Like who's left to buy after you if there's like some YouTube video with 1 million views talking about this amazing meme coin that's going to make everyone rich, right? It doesn't really work that way. So the third thing, which is like number 5, I skipped a few, is understanding risk. And like I mentioned, in a bull market, people that don't manage risk get rewarded. But in a bear market, people that don't manage risk get wrecked. And I really like this chart. So, it's pretty common for, I guess, retail investors. Sometimes people are like, why would I buy Ether or Bitcoin when I can buy a meme coin and 100x, right? Because the more risk you take, the more return that I guess, coin or investment opportunity should have, right? In theory, this is true. However, that's not really how it works, right? You should think about it in the sense, like it's not a linear relationship. There's always variance, right? There's always a standard deviation. Just because something is higher risk doesn't mean that it's going to give higher returns, right? Sometimes something that's high risk is destined to just go to zero, right? Like you can't just view something as high risk and be like, oh yeah, like it's going to go up a lot. Sometimes you buy an altcoin thinking that if Bitcoin goes up, this altcoin will go up way more. But sometimes, right, like Bitcoin goes up 10% and your altcoin goes down 10%. And then it's like what is going on? Chances are, like maybe on that particular day, there's like not that many buyers, right? Because it's a very high risk investment. there's a chance, right? There's a chance that you bought the right coin and it just goes up a lot. But there's also a chance where, you're kind of stuck in this, I guess like the left side, or, in this instance, like the bottom of, or not the bottom, like the left side of this bell curve. Um, like if you go on social media, people only talk about the outsized gains, right? Because people don't want to talk about their losses. And social media is kind of like Instagram for like, I guess, I don't know, like it's like social media for like lonely men that trade internet coins, right? So people will like just keep talking about, oh my god, like I bought these 10 meme coins or whatever, they're all up so much, but they don't talk about like the 90 other meme coins that they lost, like 100% on, and like the 10 meme coins that actually pumped only made up for like part of, I guess, like those losses. I think this is really really important, like because this also applies, right? If something can be low risk and have like pretty asymmetric risk returns. But I think social media kind of glamorizes people that just take on a lot of risk, and get like return. There's always survivorship bias. You'll notice like the 10 people that like made a bunch of money, right? Turned like $100 into $1 million, but you don't hear about like the millions of people that just like lost it all. And now, they're just like, I don't know, not in the crypto markets anymore. Right. Oh yeah. I mean, this is kind of the same thing I talked about, but there's always survivorship bias, especially on social media, because people don't really talk about their losses. Number 6, similarly, is recognizing risk, and this is interesting, right? If the system is stable, so if the outlook for the markets is very stable, people, because of greed, will make it less stable through more leverage, right? Because if people think that there's no risk in the markets, it's like, oh, like we should all just lever up our exposure and like buy more coins. But that act of being in a stable environment leads us to take more higher risk decisions, which create like less stable environments. Like, does that make sense? And I think there was this moral hazard risk where someone, I believe, so I think, I'm not going to redo this, but there was like this instance where some company made like rock climbing gear, which made rock climbing very safe, or like much safer than previous rock climbing gears. However, because they advertised that this thing was more safe, people took this gear, right, and used it to make higher risk decisions, right? Like they took on like higher risk like courses, right? So instead of like going like the safe path, they went down like this higher risk path because, hey, like I'm using this gear, it's so much safer. But the act of using something that makes you feel safer, like makes people take on more risk, and because of that, right, introducing this new safe rock climbing gear actually led to more accidents. So similarly, right? I mean, in crypto, it's like leverage, right? Oh, like like the Bitcoin ETF, right? Like let's 10x long Bitcoin, and it goes up, right? But if everyone 10x long Bitcoin, then all it takes is like one player to be like, you know what, like let me just take profits and go to the Bahamas, and then everyone gets liquidated, and like that's the market giveth and the market taketh. Yeah, if the environment's very safe, then people take on risk, which makes the environment not safe for risk taking, which I think we've seen in like the last bull cycle, right? Where we were in a bull market, and then people just like take on way too much risk for outsized returns and just got wrecked. Namely things like 3 Arrows, Celsius, BlockFi, things like that. And I guess like relating it to the markets, it's like this time is different, right? This time is never different. Super cycle, right? Institutions are buying our bags. Valuations, FTV doesn't matter, right? And this is partly true, right? But FTV doesn't matter until it matters, and then prices will like get absolutely nuked. So some things are true until they're not. That's something to always keep in mind. Number 9, or the next one, is awareness of the pendulum. So this is more, I guess, alluding to sentiment. When things are going well and prices are high, investors rush to buy, forgetting all prudence. Then when there's chaos all around and assets are on the bargain counter, they lose all willingness to bear risk and rush to sell. And it's always going to be that way. And Marx talks about the 3 stages to a bull market, right? From a bear market to a bear market to a bull market. And you can kind of think of this as like the post FTX scenario in the crypto markets, where FTX goes down and then everyone's like, oh, like crypto's over. Bitcoin's at $16,000. There's no way things can recover. But obviously, like that's when you want to buy, when no one thinks that things can get better. At the bottom of the bear market, few people to begin that things can get better, and they start to buy, right? And the sentiment for the holder base becomes, you know what, like it can go lower, but I think there's enough upside. I just want to buy these coins and just hold, right? And coins go from weaker hands to stronger hands. And as this, I guess, transfer of wealth happens or transfer of coins happen, prices go up. And then as prices go up, people come to the realization that improvement is finally taking place, right? It's like, okay, like people sold their Bitcoin at $16,000, and now that it's at $40,000, the same people are coming back because, oh, like we're back, right? We're back. But I mean, that's natural, right? That's part of like the process from bear to bull. And then at the later stages of bull market, everyone thinks that things will only get better forever, and that's when you should be selling, right? It's really easy to say buy fear and sell greed, because like when you're living in like each individual moment, it feels like things will continue to get worse and things will continue to get better. But I think from a risk management perspective, and also Howard Marks, right? I mean, he runs like a fund with like over $160 billion of AUM. So of course he has to be very, very prudent. And he's not going to go for like these 100Xs. But it's going back to the original point. If everyone thinks that things will get better forever, everyone's already bought. And if you go on social media and you see, like people call for a recession and crypto prices has to go down, or like, if people are worried, you should be grateful, right? Because the people that are worried, like they're not allocated, right? So those are going to be the type of people that will eventually buy after you. But if you go on social media and everyone's like not really calling for downside, then you know that everyone's allocated. So there's a saying: bull markets climb wall worry. And whenever I go on YouTube or social media, and there's like these recession videos that have like hundreds of thousands of views, I'm like, okay, like that's really, really good, right? Because there are so many people that buy into like Peter Schiff, right? It's like, don't buy stocks, don't buy Bitcoin, right? Just buy gold, right? And gold is like not doing anything. You kind of need those people to exist, because they're going to be the ones that's going to be buying after people like you and I, hopefully, right? Hopefully. And they're going to be the ones like that's going to be selling at the lows. Number 10 is combating negative influences. And this is also around sentiment. There's always the desire for more, right? When the markets are going up, you see people online like get 100Xs on meme coins, and you're like, wow, I'm underperforming, right? I need to get more. But the fact is, if you're making any money from markets, then you're doing better than, let's say, 80% of the population, right? So you have to be humble. You have to be content with, I guess, like whatever situation that you're in. Because if you're just always looking for more, right? Sure, you might make more in a bull market, but then, at some point, like you're gonna like just lose a bunch. And there's always ego, especially in a male-dominated industry like crypto or just like finance in general. It's just like a bunch of men just trying to one-up each other. It's like, oh, like my dick is bigger than yours. I have more money than you. Look at my watch. Look at my car. I mean, it's kind of like toxic masculinity all around. And it's really challenging to remain objective when everyone else is making so much money than you. But think about all the people that were around, I guess, in 2021, and think about, okay, like how many of them are still left, right? How many of them are still posting YouTube videos, posting Twitter videos, Twitter content, or like, there's always a cycle, right? People, the market giveth and the market taketh. Investment results are evaluated and compared in the short run. So you can have like a very bad investment strategy or trading strategy be rewarded in the short term, because the markets are going up, right? And you might look at that person or that manager or like that influencer. This applies to me too, right? Like I have periods of outperformance and severe underperformance. And I often say that I'm a mid-curve, right? That's kind of like the meme that people have been pointing at me because I give mid-curve takes, which is fine, right? I'm happy to be in the mid-curve, right? I represent 69% of the population. But anyways, incorrect, right? Even like bad decisions, right? Like mathematically or objectively bad trading decisions can be rewarded in the short term. And if the market just looks at that person and be like, oh yeah, like that guy is very smart because he made a bunch of money, that can lead to poor decision making because you don't really know how much risk he really took on. And I think I talk about this later in this video where I read like this book by Nassim Taleb, Fooled by Randomness. And unfortunately, when I was reading that book, I wasn't like taking screenshots of these excerpts. But Sometimes like you can buy something because you have a particular thesis, right? I think this coin is going to go up because of these reasons. Okay, and the token just might go up, but it might be for the wrong reasons, right? And you're being rewarded for doing poor analysis. But in the moment, you don't know that because you're making money. That's the most dangerous part, right? And you have to be self-aware and be aware that sometimes like things will go up for the wrong reasons, right? And things are going to go down, and you have to be aware. Like you have to be willing to switch. Like I made money, but I was wrong, right? And fortunately, the market gave me this opportunity, but I'm going to sell because I was wrong on my original thesis. That's fine. Sometimes markets are going down and be like, yeah, like I was wrong. I'm going to take a loss. Or markets go down and you're like, you know what? I still believe in the thesis. You have to be kind of data dependent, right? Maybe this is like why people call me mid curve, right? Because I don't just ape in things, right? I just like look at the numbers and be like, okay, like this is good, right? This is good. When it doesn't really matter. But the only way to analyze whether someone is successful is longevity, right? Anyone can just make money over like a 2-month period, but can they really make money over a 5-year period, right? That's kind of like the best way. The best returns bring the greatest ego rewards, and when things go right, it's fun to feel smart and have others agree. And I guess like personally, I guess like the 2020 and the 2021 cycle was like my first real bull cycle in crypto. And my YouTube channel, this YouTube channel went from like 1,000 subscribers to like 90,000 in like 12 months. And I continued to make videos, and I was rewarded because people watched my videos. And at the time, I didn't really notice this at the time, and it was pretty obvious in hindsight. But I had like this psychological bias or like this block where I felt like I had to keep, buying new things and like, bringing new ideas, because that's what people will watch my videos for. And that virtuous cycle allowed me, or it basically got me to like get wrecked in like in like the last bear market. And this time around, I'm like, okay, like I don't really need to like talk about new things all the time. I'm just gonna do my own thing, and then we'll see how it goes, right? And like sometimes I'm wrong, sometimes I'm right, but I'm just gonna do my own thing. And that like I had to get wrecked first in order for me to get there. But like that's one example, right? It's like the first time around, it's like I don't really know what I'm doing, and then I'm being rewarded for doing these things, so I'm gonna keep doing those things. But at some point, doing those things allowed me to get wrecked, and then now I'm like, okay, like I'm just gonna do my own thing, right? That's kind of I'm not sure if that's relatable, but yeah, I guess like that's my personal anecdote. Yeah, like never feel bad for buying something that goes up 10% and then your friends buy something that goes up 30%, right? Just be happy that you're making money. And you don't realize this in a bull. You only realize this once everything goes down. But just something to be aware of. Yeah, crypto Twitter is like Instagram influencer feeds. What you see is super curated. Don't feel bad if you aren't absolutely crushing these moves. It's not as easy as it seems. If you're making money at all, you're doing better than most. At the end of the day, we're all on our own timeline, right? It's like you don't have to make all your money like next month, right? Like why not just make a bunch of money over the next 3 years, right? If you're young, then yeah, like that's fine, right? But of course, social media kind of incentivizes people to try to make the most money as they can in this short period, in a short period of time, because like that's what people join crypto for, which is fine, right? People should enter crypto to try to make money, but people shouldn't do it for the wrong reasons, and people should try to do it in a sustainable manner. A lot easier said than done, of course. Just, if you're like a risk avoidant person, just be okay with, I don't know, like low volatility positions that make less money, but like if the market dumps, you're less protected, or like more protected, right? That's fine. Comparing yourself to others is a surefire way to eventually get wrecked in the markets. Take it from me, take it from other people. It just happens. 11, the most important thing is contrarianism. Sometimes things are too good to be true, right? It's the similar idea of, well, if everyone knows that, then like who's left to buy after me? And similarly, in a bear market, sometimes you have to think about, no, that's too bad to be true. So you can kind of think about FTX, right? Is crypto really going to die? Probably not, right? So just buy. Solana, right? Like, is Solana really dead just because FTX invested? Probably not, right? So like, maybe it's good to buy. Of course, I didn't do that, right? Because I'm a mid curve, but sometimes you have to ask yourself, it's probably too bad to be true. And you see this with, for example, like with like Manta Network. I mean, okay, like I don't really care about this token, right? I got some airdrops, and people were frustrated with the Manta airdrop because it didn't really go according to plan, according to most people, right? And people online is like, oh, like Manta's dead, Manta's dead. It's like super bad coin. But then you have to ask yourself, like, is it really, right? I mean, they raised so much money. I mean, the team is pretty strong. They're all doxed. It can't be that bad. And now the token's going up. That's a bad example because if you're watching this video in like 2 months from now, then it might be like nuking. But like I'm living in the moment. So that's one example. You have to ask yourself, like, things can't be that bad, right? Like, is it really that bad, right? Also, is it really that good, right? You have to think about that. Yeah, Solana is a good example. Number 13, patient opportunism. Right, the market is not very accommodating to you, right? It won't provide high returns just because you need them, right? It's like if you buy a coin and it goes down, it's not going to go up because you're down, right? I mean, the market doesn't care about your position. Similarly, if you buy something and it goes up 10x, the market doesn't know that you're up 10x, right? I mean, they don't care, right? It's just the current price. And there's this really, like, one of my favorite quotes from the book is from, like, I guess, like this interview with Warren Buffett. And he kind of compares investing with baseball, right? Where if you're, playing baseball, I used to play baseball, and there's like this concept of, waiting for the perfect pitch, right? Don't swing at the curveball on the outside corner. Don't swing at the two-seam fastball at the upper half of the plate in the inside corner. Just wait for a fastball right down the middle, and then just take a big swing and hit a home run, right? Just wait for the perfect pitch. But of course, the more competitive leagues that you eventually enter, the pitchers become much better, and then you can't just wait for a perfect pitch. You have to swing at some point. But investing, there's no concept of striking out, right? You can literally, like imagine you're on Twitter and you're like scrolling, and then there's like 100 different people shilling 100 different coins, right? Like, you don't have to swing at those, right? You can just ignore all of them. And maybe they all go up, right? And then you're like, oh, like I should have bought something. But it's like, it's fine, right? The only way to get wrecked in the markets is to buy something that just like goes down 99%, right? Like, that's like the only way to get punished in the markets. Of course, there is opportunity cost where if you're just sitting in cash and the S&P is up 20%, then yeah, like you're like being diluted essentially, because there's like just holding this melting pie, or like this melting ice cube, as Michael Saylor says it. But just sometimes, right, you just wait for the perfect pitch, right? And just like buy, like ape into that. And there's this quote by XMNGR. I couldn't find the original tweet because I think the guy deleted his account. But there's this tweet. In discretionary trading, the right position is almost always flat. The right action is almost always to buy a banner. Actually, that was wrong. But basically, the idea is, all you have to do. Okay, I'm not gonna edit this out because I'm in way too deep. I picked the wrong screenshot. Anyways, the tweet was, the right action is to just wait for the perfect opportunity 5 times a year. Just pick up the free money, and then that will result in outperformance, right? Oh man, this is bad. This is such a bad section, but whatever, right? Just a few times a year, there's going to be like free money opportunities, right? It's like buying USDC at like 93 cents, buying Bitcoin pre-ETF announcement, right? Or, like leading up to the ETF launch. Those were pretty obvious, like free money opportunities. All you have to do is identify them and just like bet big on those. And then you'll naturally outperform. You don't have to trade every single day, right? In fact, it might benefit if you just don't trade at all for like 2 weeks just to clear your mind, right? You don't have to always be in the markets. The best way to outperform is to just stay flat and pick up the free money on the floor whenever the opportunity arises. And look, I'm not saying that you should be sitting in 100% cash and like just like buying things a couple times a year, right? It depends on your style, but that was just an example that I wanted to give. Unfortunately, I picked the wrong screenshot, and I think it was like some random NFT project that was being shilled. But hopefully you got the idea. Number 16, the most important thing is appreciating the role of luck. Every once in a while, someone makes a risky bet on an improbable or an uncertain outcome, and ends up looking like a genius because they're right. But we should recognize that it happened because of luck and boldness, not skill. Um, yeah, and understand the role of randomness in the world. And to understand this scenario, I want to talk about this excerpt. So I guess this is also like a Warren Buffett quote. Yeah, so I don't think this actually happened, but actually this might have happened. But uh, there, let's just assume that there's like this scenario where you take 225 million Americans and you give them all $1, right? And they flip a coin once a day. And if they're right, they get $1. If they're wrong, they lose $1, right? It's pretty simple enough. And let's just assume that, every day, like half of them win, right? So 225 becomes 112.5. That becomes 6.25, every single day from 225, it gets cut down in half, right? After 10 days, 220,000 people have called it right 10 times in a row and they made $1,000, right? They're not skilled, they just got lucky. But I mean, they exist, right? That's a lot of people, right? Like super smart looking. They may try to be modest, but at cocktail parties, they'll occasionally admit to attractive members of the opposite sex what their technique is and what marvelous insights they bring to the field of flipping. After another 10 days, so 20 days in a row, right? Like flipping a coin 20 times in a row, there's 215 survivors out of the 225 million, and they each won $1 million. I mean, that's crazy, right? And then, some of these people, right, they're gonna write books titled like "How I Turned $1 into $1 Million in 20 Days, Working 30 Seconds a Morning," right? And then they're gonna like go to all these seminars or something, right? Sound familiar? Of course, right? I'm not really like bashing on like people that do seminars, but I mean, I'm like just taking this excerpt from a book. But you have to understand the role of luck that could happen, and you might just have a group of individuals that just like made a bunch of money from like $1 to $1 million. But I mean, they just like happened to win 20 coin flips in a row and got extremely lucky. The other 224.9 million people, right? They just got wrecked, or they lost it all essentially. But like that's kind of the role of luck. Investors are often fooled by randomness. We don't know whether someone was right for the right reasons or was just lucky. And the only way to judge whether someone is good is by longevity. And you have to evaluate, I guess, their past cause and analysis. That's really the only way, I think. Yeah. A coincidence, right? There's always a coincidence, because people like to be like, okay, like why did that coin pump? Oh, that coin pumped for these reasons. People don't like to just, people don't like hearing that. I mean, that coin went up because a few rich people bought on that particular day, right? People just want to have a reason for something, because otherwise there's like this cognitive dissonance where like they have to understand something, right? Otherwise it's not true. Let's see. Yeah, and this is kind of redundant. But randomness alone can produce any outcome in the short run. And in the short term, like people can just make a bunch of money, but it's not really by skill, it's by luck. And I think that like understanding that allows us to be more humble about the markets. I read both these books, Fooled by Randomness and Black Swan. Highly recommend them. Really good books. Talev is anti-Bitcoin, which kind of sucks. Because I feel like he's the type of person that would understand Bitcoin. But still, I mean, it's still a good book. I highly recommend these two books. Number 17, investing defensively. There are old investors and there are bold investors, but there are no old, bold investors, right? That's pretty good. Let's see. Yeah, like people blow up not because people don't blow up because they don't have enough winners, but because like they have too many losers, right? They bet too much when they think they have a winning idea or correct view of the future, concentrating their portfolios rather than diversifying. Of course, right? I mean, he runs a $160 billion portfolio, so he has to diversify. I still think that, me personally, I'm a fan of concentrator bets because it allows me to like look at less things, and I can kind of hunker down on a few things and like be really understanding of like that particular sector, narrative, etc. And for that reason, like I focus on like DeFi, yield farming, airdrop farming, instead of order flow for Bitcoin, right? Or like on a like stuff like that. I try to be really good at a few things instead of like trying to diversify. And of course, you can diversify and be really good at a few things, obviously. But I'm a fan of, like, I guess, concentrated bets, especially in crypto. But I guess, the idea is, okay, like, maybe you can have concentrated bets in crypto, but you should also diversify in other asset classes like stocks or, even short-term treasury bills or like real estate. And like that's like the only way you can actually survive. So hopefully you can see this, but I'm just gonna go off full screen so you can read everything. The 19th, right? The most important thing is adding value. Yeah, and like the only okay, so I mean, let's go through like these quadrants. There's like the aggressive investor and the defensive investor. There's ones without skill, and then there's those with skill. Aggressive investors without skill, they gain a lot when the markets go up, and then they lose a lot when the market goes down. Defensive investor without skill, they don't really lose much when the markets go down, but they don't really make money when they go up, right? Because they're always scared about the next 50% correction in the S&P 500. Aggressive investor with skill, they make a lot when they go up, but they don't really lose that much when the market goes down, right? So like maybe they 10x their portfolios, but they don't go down 90%, right? Maybe they go down like 40% or 50%. I mean, that's still pretty good, right? You turn, let's say, 1,000 into 10,000, and then it goes down to 5,000 in the bear market. I mean, not ideal, but that's still good. Defensive investor with skill is they don't really lose much when the market goes down, but they still make a decent amount when the markets go up. So they're going to underperform generally the broader market, but if you think about the Sharpe ratio, they have alpha because maybe they capture 80% of the move, but they only like lose. If the market goes down 10%, they only lose like 3%, right? So from like an investment strategy perspective, it makes sense. And I think it's really important to determine where you are on the spectrum. Like it's okay, right? Like I mean, in a bull market, like the aggressive investors like makes a bunch of money, and the defensive investor like makes less money, but they still make money, right? Be happy with it. In a bear market, like the aggressive investor just gets wrecked, but like just don't get wrecked too hard. And the defensive investor looks like a genius, but you also have to account for the fact that they didn't really make that much in a bull market. The important thing is like you have to recognize where you are on the spectrum, and like for example, if you're a defensive investor and you see someone on the timeline becoming like make a lot as an aggressive investor, like don't try to copy trade that person, right? Because I mean, you have different risk tolerances. I think self-awareness is like very, very important. And the last thing is putting it all together. So I mean, I don't even know how long this video is. Let's see. Okay, 38 minutes in, right? Obviously, right, the best teacher for markets is the markets itself. It's easy to listen to someone say, like take profits, right? Buy when others are fearful, sell when others are greedy, right? It's easy to like watch someone say that or hear someone say that and be like, yeah, like that's what I'm going to do. But when you're in the markets, I mean, it's not that simple. And I think the best way to learn is by just constantly, trying new things, constantly getting wrecked, constantly making money, and then figuring out your best strategy over time. Honestly, like, if you don't do that, then, you can't just like listen to others. Like you have to feel the ups and downs yourself in order to, I guess, really internalize what the markets can give you and what the markets can take away from you. And like I mentioned, my favorite section was like the whole striking out section, right? Or like the baseball analogy with like Warren Buffett. It's like, yeah, like there's a bunch of good traders I know that literally like buy a few things, go on vacation, come back, and like they buy like a few things a year, right? And they ignore like the noise that happen on like social media every single day, and they're able to identify like what really matters and like what doesn't matter. And I think like understanding like in baseball, right? You do have to swing at some point in baseball, right? But when it comes to investing, you don't have to always swing. You can just be really selective with the types of bets that you make, and just like really manage that position very, very carefully. Like the only way to strike out in crypto or like investing in general is by not managing risk, and like levering long a coin, and then just getting wrecked because markets go down. And Howard Marks is a value investor, right? He doesn't like buying tech stocks. He likes buying older companies. I mean, okay, I'm kind of generalizing here. I don't mean to like knock on Howard Marks. Obviously, he's like very successful, and I'll probably never be able to like get to his level, obviously. Um, but I do think that crypto fantasizes like these 1000x gains, but in crypto, there's also like pretty good ways to just like make 2, 3, 4x's in size for relatively low risk, and you also have to be grateful for those types of opportunities, right? Like I know people that like they don't really buy coins. Like all they do is stablecoin farm, right? And they have like $1 million portfolios, and then they make like 30, 40, 50% a year, and they just live off of that income. I mean, that's also like a pretty respectable way to play the markets, right? Um, and then maybe like that person, right? They spend 99% of the year just stablecoin farming, and then occasionally, like once a year, twice a year, there's like this super obvious play that they see, and then they risk like half their portfolio, and they capture like a 2x, and now they have like a $1.5 million portfolio, and they can generate 50% a year on that, and then they make like 750K a year, and like that's like a pretty good way to also approach the markets. It's just that like it's less talked about, I suppose. Um, Understand like your own self, right? Your own risk tolerance. um, if you're you know a low risk investor, then just understand that you're going to make less money, but you can't really complain about that because by definition you're taking on less risk, I suppose. But even within like the low risk profile, there's still ways to, I guess, generate pretty decent returns. And yeah, crypto sentiment, I mean, yeah, the idea of a pendulum is very important, I think, because you know, social media, and I did an interview with CL, right? CL207, like the cat on Twitter, which you can see on my channel. But he mentioned that social media is the fundamentals, right? Because if a project is good but no one's talking about it, then the token is not going to go up, right? So attention, right? You have to monitor attention. And in crypto, because most of these coins don't really have like real fundamentals, it just like trades off narratives. Um, Sentiment can also be driven by social media. I mean, like even like a couple of days ago, right? Like Bitcoin like fell 20%, right? Which is like pretty standard. And then everyone's calling for like 20K or something. And then prices go up like 10%, and everyone's calling for new highs. It's like what are you guys doing? Like, are you really trading every single move, right? Just understand that social media is full of noise. Just do what makes sense for you. Um, Patience is very important. People overestimate what can happen in the short term, but underestimate what can happen in the medium to long term. Especially for like emerging tech that gets super hyped. I think that's very, very true. Um, you know, how do we find these winners? It's easier than done. But Marx, right? He believes that if you just avoid the losers, the winners will eventually find you, right? If you just like, if you're just patient, right? I think he used the term patient opportunism. If you just manage risk, right? Maybe just limit your exposure to the majors, and then once in a while, right? Like bet big on something because it's so obvious, right? That's also like a good time, like a good way to, I guess, invest and whatnot. Um, and I guess that's also like part of my journey. I think yield farming, airdrop farming. Sometimes it doesn't really pay well. Sometimes it pays really, really well. Like that's like one way to like manage a portfolio, right? You just have like these longer term bets, and then with like 10% of your portfolio, you like airdrop farm in something, and hopefully you have like an asymmetric risk return. Sometimes like maybe you're a trader and you don't care about farming. That's fine, right? Just understand that like that's kind of who you are. And yeah, that's gonna be it for me. If you enjoyed the series, make sure to read these other two, I guess, summaries I've done. I'm gonna hopefully over time read more books and then make summaries. And I also have Twitter threads on this. If you care. It seems like we're entering a bull market, so hopefully I still have time to read these books. But hopefully you enjoyed the book series. And I think, yeah, that's going to be it for me. So thank you guys for watching. See you guys another time, and have fun farming out there, and, maybe make money. Bye-bye.